There have been some interesting property headlines recently, haven't there? I've been reading things like Australia's house prices have seen the fastest quarterly decline on record. Australia's property market crash is coming, and this is why. The chances of a house crash have just jumped. And the interesting one was a Freedom of Information report revealed internal research by the RBA found that property prices could fall by as much as 20%. So is a property crash really likely? Well, that's what I was recently asked by Nathan Veccio, mortgage coach and Brisbane-based mortgage broker at Hunter Galloway, in an interview for his YouTube channel. And considering thousands and thousands and thousands of people watched the interview and over 90 people commented on this interview, I asked Nathan permission to replay the audio version for you, for listeners to my podcast. And I think you'll find the questions Nathan asked me insightful, and even though you may have already heard some of my views on what's ahead for property, considering all that's changed just in the few weeks since we recorded this interview, I think my comments are even more relevant than ever. So rather than being overly worried about inflation and rising interest rates and all the economic woes, and sure, they are happening, but I want to put them in perspective for you, so please take the time to listen to my thoughts, and I hope at the end of today's show, you'll have a bit more clarity of what's ahead. So, welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Michael Yardney is one of Australia's leading property commentators, and he's been voted Australia's most influential thought leaders. He's CEO of Metropole Property Strategist, #1 best-selling author for 9 books, as well as host of the very popular Michael Yardney podcast. Michael, welcome to the show.
Thanks, Nathan. Thanks for asking me back.
Now, we've seen a bunch of predictions about the housing market to crash. Michael, we'd love to get your thoughts on the ground. What's actually happening with property market?
Well, there's not one Australian property market. So the commentators are saying the Australian property market is going to crash. There are always the negative Nellies that say this, but this is some bank economists and leading economists who are predicting 10, 15, 20% crash in the Australian property market. Nathan, it has never dropped as much as that. There's no doubt that the Australian property market and certain segments are dropping in value at the moment, and we can dig into that in a moment. But the overall fundamentals for our economy and our property market are good. What's currently missing at the moment, Nathan, is consumer confidence. So people are sitting on the sidelines. They're waiting to hear that's what interest rates are going to get to. That's all we're going to have. Oh, inflation's under control. No, we're not going to get into recession, because at the moment, anyone who wants a job's got a job. The incomes may not be going up as much as they want, and yeah, household costs are going up a bit, but most Australian households are financially secure. It's just they're not confident in the future, and in many ways, that's the media's fault, Nathan.
Definitely. And you mentioned some segments are probably hurting more than others. What do those segments look like, and what are you sort of seeing based on the buyers that you're helping and who's sort of coming through?
Well, the Melbourne and Sydney property markets led the recent boom. So over 2020 and 2021, Australia experienced a once-in-a-generation property boom. Why I'm saying that is we have booms, we have busts, the cycle moves on, but this was one that's unprecedented, where every property, A-grade properties and D-grade properties, capital city properties and regional properties, apartments, houses, townhouses, all went up in value. And this was a combination of factors that led to it. In particular, low interest rates, a lot of stimulation. The government created a property boom because it recognised the benefit of the wealth effect. If people feel wealthy, if they read that the value of their home's going up, if they feel comfortable, it stopped the concerns that we had that the COVID cocoon we were locked in could maybe create unprecedented levels of unemployment, could have created a recession. So this was an orchestrated boom. It actually worked. They gave out first homeowner grants and all sorts of incentives. But now that incentive has gone. It was unsustainable. The property market grew to close to $10 trillion in value, the residential property market. And over the COVID period grew by almost $2 trillion. Now, people say, everyone took on debt. But against all those properties, Nathan, you're in the finance business, you would know, there's only $2.1 trillion of debt. Now, I'm saying only 2.1 trillion, but that's an overall loan to value ratio of, 24%. So overall, some people have overcommitted themselves. The Australian property market's doing nicely. But now moving forward, what's happened is the people are nervous and interest rates have gone from their stimulatory levels to, probably now almost neutral levels. But people can't borrow as much, which means that their borrowing capacity has dropped. And the combination of these things have meant that the high-flying markets of Sydney, the upper end of Sydney and Melbourne in particular, have come down considerably. But those markets are always more volatile. Apartments haven't dropped as much in value. And interestingly, regional properties where people were moving out from getting away from COVID into a different lifestyle, they held their own for a while, but they're falling in value now too, but mildly. So overall, the Australian property markets have only fallen around 3% over this year, but in certain segments of Sydney and Melbourne, they've dropped in value up to 10%, Nathan.
And what's your views? We've heard commentators saying that they think the market's going to fall by 15, 20%. Where do you see, what's your horizon from here? What do you see in the next 12, 24 months? You've talked about Sydney, Melbourne maybe going down, but overall arching theme, do you think property is going to bounce back or do you think it's going to be subdued for a little bit? What are your thoughts there?
Okay, so the argument is when interest rates fell, people could borrow more and so therefore property values went up. And that's right. Now they're saying borrowing capacity, and being in the finance industry, you'd know that better than me, borrowing capacity has probably dropped 20% because interest rates have gone up and the Reserve Bank's probably going to have a couple more interest rate rises. But let's imagine I'm a buyer and I could borrow for $1 million and now I can only borrow $800,000, but you're wanting to sell your property. Now, you don't have to sell your property. You've got a job, you've got security. Yeah, your mortgage costs are a bit more, but you're not in mortgage stress. And remember, most sellers are buyers because they're homeowners anyway. Why would you drop your property in value to $800,000? Because that's all I can borrow. What I'm going to have to do is find something I can buy. So I won't be able to buy your $100 million property. I may have to buy an apartment. I may have to buy a townhouse, or I may have to move out a suburb or two where my budget will allow me. So what are you going to do? Suddenly you lost me as a buyer, but you may have to come down a little bit, but somebody from the adjoining suburb, which they may have been able to borrow 1.3, now can only borrow $1 million. So they're going to come to your area. So as long as there's no forced sales or desperate vendors, and that's unlikely to happen as long as everyone who's got a job, or what wants a job has got a job, then I can't see 20% falls or 15% falls, because at the moment the cloud covering the sun is the lack of consumer confidence. But underneath that is households are in good financial position. They've stored a lot of cash. They're working on their savings, but they're spending. The economy's doing well. It's slowing down. The Reserve Bank wants it to slow down. It's making it slow down to slow down inflation. Jobs growth is strong, and we're going to get close to 200,000 migrants this financial year. But currently, there's only 33,000 properties advertised for lease. Now, most new migrants rent for a year or two till they find their feet, till they find their job, till they find a community. But of those 33,000 properties for rent, probably only half are for lease. At Metropole, we manage properties for clients in Melbourne, Sydney, Brisbane. We have close to $2 billion worth of property under property management. And when a property comes up for lease, even before it's vacant, we put it on the internet, on realestate.com and Domain, as do other property managers, to try and find tenants. So half those properties advertised are probably not even available yet. So there's going to be a huge shortage of rental property, a huge inflow of new people coming to Australia, and these migrants are going to get jobs. So they're not going to be have problems because they've been selected because they're the people who want to have jobs, who've got the skills that we need, I should say. And the other group of people coming are the students. That's great because the international students support a big part of our economy. Education is a great export industry for Australia, and there was some concern that maybe moving forward the education sector would move to Zoom. But in fact, the answer is no. They're coming, maybe not from China as much, but from India and other countries. They all need accommodation as well. So what I'm pointing out is the fundamentals are good, but the cloud covering the sun at the moment is uncertainty. And when that moves, and it will, and we can have a talk about when I think it will happen, then the markets will pick up again, Nathan.
And I think, Michael, this would be great to get. I mean, you talk about this cycle. I know you've got a lot of experience being in the property industry. Maybe we take a step back and you talk about the cycles you've seen in the past and how there might be some similarities to what we might be in the eye of the storm, or maybe at that point where a lot of people are getting that clouded vision, that the clouds are covering the sun and they're not actually seeing the birds from the trees. So do you want to explain to us maybe what a typical cycle might look like and where we are in comparison to that?
So some people draw the cycle as a clock, others draw it as a wave moving on, but typically people see 12 o'clock as the boom in the property cycle, and then there's a downturn. Every boom always leads to the next downturn, just as every downturn leads to the next boom stage of the cycle. And people are most confident at the boom stage when the media is full of positive messages, auction clearance rates are high, property values are going up. But cycles don't occur because of a specific period of time. It's often said they're 7 or 8 years. It's got to do with a whole lot of socioeconomic factors. And there are cycles within cycles. So Melbourne works at a different cycle to Sydney, to Brisbane. And similarly, within Melbourne, there's the inner suburbs, the outer suburbs, the middle ring suburbs, apartments, townhouses, new apartments. So as I said, what was unusual recently in the recent boom was everything was in sync, in synchronous. But now it's actually a bit different. So the market has moved to the downturn stage of the cycle and into a slump stage. And if you look at the property clock, we're probably around 5 o'clock. And then eventually confidence is going to come back. So at the moment, fear is stronger than greed, the two emotions that drive human sentiment and markets and cycles. So currently, FOMO, the fear of missing out of last year, is gone, and now it's FOB, fear of buying early. But I think later this year or early next year, people are going to realise, hey, inflation's under control. Yes, it went up to what they said, and now it's under control. It's going to come down. I think after 1 or 2, maybe even 3, but more likely 2 interest rate rises, people are going to say, hey, that's about as bad as it's going to get. Okay. And they're going to get on with their lives, because at the moment people are putting their lives on hold, but they're still getting married, they're still having babies, they're still getting divorced, they're still moving jobs, they're still moving interstate, they're coming from overseas. And once they are more comfortable and greed overtakes fear, the cycle will move on. So when consumer confidence comes back, we'll come to the bottom of that clock in the property cycle where buyers will get in, vendors will start putting their properties on the market. And I know while a lot of your clients and our clients think as property investors, 70% of the market's driven by owner-occupiers. So buyers are sellers. If I'm going to sell my home, I've got to move somewhere else. So houses are going to come on the market, but new buyers are going to come on. And so the market stabilizes. It doesn't suddenly get into a boom again. And after a period of stability of property values, then the market will start to pick up again. And while the clock represents a boom between 9 o'clock and 12 o'clock, the boom is the shortest phase of the property cycle. It doesn't go for very long. I don't know when the next property boom is going to occur. I don't even want to predict that. So I don't like making forecasts. I have expectations. So I expect the property market to even out soon. And then what's going to happen is, as consumer sentiment picks up, people will come into the market, but a lot of people will still be priced out, Nathan. Interest rates are higher and will go up a bit more, drop a bit, but they're going to be different to the last couple of years. Inflation is going to have hurt some people. Their cost of living is going to have gone up. There are others who would maybe be first-home buyers. Their rents will have gone up a bit too much, so they're going to have difficulty getting into the property market. So I see moving forward a much more fragmented property market where some people are just not going to be able to do anything for a while, but there's always going to be people with higher skills, higher wages, multiple sources of income who are going to be able to afford to and prepared to pay to move house, to keep growing, to have going to family formation stage of their age, as a lot of millennials are. So some segments of the market will do well. And unfortunately, it's not a judge of people, but I believe the lower socioeconomic areas and the first home buyers are going to stagnate for quite a few years, Nathan.
It'll be interesting to see how that plays out. Do you think there'll be any government intervention if the unaffordability piece continues to stay out of hand? Do you think the government might come through with more? We've seen the home guarantee scheme. We've seen home build schemes. Do you think there'll be more of that to come in years and months ahead?
Well, the government wants to put people into homes, but what those schemes do is create demand as opposed to supply, and that's what pushes up the values, because for most things, supply and demand is one of the factors, and particularly in real estate, in the cost and the value of assets. Now, the challenge is building costs have gone up considerably. In fact, the building costs for apartments, high-rise apartments, which is what we need more of. By the way, they don't make good investments, but what they do is they house all these hundreds of thousands of people who are coming from overseas. According to the Cordell's figures, which is an organisation that keeps track of building costs, it's going to cost today maybe close to 60% more to build those high-rise towers than pre-COVID. Houses are costing about 25% more. A lot of the apartment buildings and the new housing estates that are on the drawing board are not financially viable at the moment. Developers are there to make money, not make a loss. If they can't get the pre-sales, they're not going to build those towers, which means that if there is demand driven by incentives like the first homeowner grant, which is fantastic, we've got a lot of people into the market, a lot of first home buyers into the market, that'll push more demand. But unless wages go up and there's more affordability, and I can't see that happening for a while, it's going to be really financially unviable to build a lot of those developments. I think it brings another question in. So what's going to happen? Because rents are going to go up. How are people going to actually be able to afford this? So maybe an area that the government could or should intervene is say, hey, maybe we should help investors because we can't build all the accommodation that's necessary. Maybe they should actually not only help first-home buyers, no argument about that, not only help the disenfranchised people, we need more social housing and private investors won't provide that, so the government should do that. And maybe they should look at, hey, maybe we should actually help the investors as a dual-prong approach. We'll build the social housing. Please, Mr. Mum and Dad investor, help create some accommodation for those people who need to rent.
Definitely. Even making it easier to do dual accommodation. I know there's a lot of areas that have limitations on the number of dwellings you can build in one area. Simple things like that. You'd be surprised, I guess, how many investors would actually jump at that. Very
much so. I agree. But at the moment, investors are seeing as ugly, greedy investors. And I know most of my clients, they're not ugly. but more than that, the government sees them as an ATM. Hey, let's tax them for this. Let's tax them for that. But most investors are not ugly and greedy. They're mums and dads. We know that most investors, Nathan, never get past their first or second property. So they're just ordinary Australians trying to develop some financial independence. And if we're given better incentives, more people would do that.
And what do you think is going on with the rental market? We talked about investors. They've been seen as greedy investors. We've seen the Greens table things to stop increasing rent. But what is actually happening in our rental markets?
Well, there was an interesting study done recently by the Property Investment Professionals of Australia that showed that over the last decade, around Australia, rents went up 11%. Not per year, over a decade, while inflation went up 25%. So rents did not keep up with inflation. And we know that over COVID, a lot of residential landlords, including me, had to drop our rents, had to give incentives for people to stay. And so for a long time, rents haven't kept up with inflation. But in the last year, rents have gone up around 20%. Now, that's interesting because you can't put up your rent as much as that always. You've got to wait until the lease expires. But there's vacancy rates rates I have never seen as low as this before. And as I mentioned a moment ago, around 33,000 properties are currently advertised for the lease all over Australia. And that's half the number of properties that were advertised 12 months ago. There are unfortunate stories on social media about people living in tents, living in caravan parks, living in their cars. It's not meant to happen like that in Australia. This is the end result of governments making it harder for investors to borrow, maybe paying a different interest rate. You'll remember a number of years ago, it would have been very difficult for your team to give mortgages to investors because banks had restrictions on how much they could increase the lending to investors. So this is now transpired that there just isn't a lot of accommodation. But Nathan, one other thing happened. Over the last year or two, a lot of investors sold up. And in general to owner-occupiers, a portion of them, hey, the market's done so well, I'm going to sell my property. No, the market's done well and your property's gone up in value. That's why you bought it. You shouldn't have sold it. But others have sold up because they're concerned they're losing control. Rental freezes, like you said a moment ago, property taxes, the Queensland land tax, which hasn't come in, residential tenancy legislation, 130 changes to the Residential Tenancies Act in Victoria last year, all in favour of the tenant. In October this year, just now, this month that we're recording this, there were significant changes to the Queensland Residential Tenancies Act. Most landlords don't know. In New South Wales, they've changed the rules that tenants have to be given contact details of the landlord, either their email address or their phone number. Hang on, that's why I've got a property manager. I shouldn't be contacted by them. So the rules are making it harder, and that's the opposite of what we need. We need more investors, not slum landlords, but people providing good accommodation because there's no end in sight in this rental rise.
100%. I think it needs to be a win-win. We've seen a lot of people moving towards Airbnbs as an alternative source of revenue and having less sort of restrictions. I think there's a statistic going around about 1/3 of investment properties in the last 5 years are no longer investment properties. They've been sold out. So we've seen such low supply, which has had such a direct result on values of rentals increasing. I think this is the second and third order consequences of government intervention around reducing the number of investors that could get in the market from a lending point of view, and also putting all these regulations, making it harder for investors to have tenants.
So people are wondering, is it worth all the trouble? Well, my answer is, what's the alternative for you as an investor? The government's pension isn't worth living on, and I'm not even sure they're going to be able to afford to have a pension as we move forward, because as we get older, the government's going to have to spend a bigger percentage of its income on health and on pensions. So as an Australian, I believe we should be looking after our own financial future, and superannuation isn't enough. In fact, most of the older people don't have as much superannuation because the superannuation scheme only came in maybe around 30 years ago. But I agree with you that what we should be looking at is ways of being fair to both the tenants and the landlords.
Where do you think interest rates are going to go? We've seen the Reserve Bank increase the rate for the last 6 months in a row. There's talks of the cash rate getting as high as in the 3%. We're currently in the 2.8s. What do you see happening here?
Okay, so this time last year, the Reserve Bank said, we're not going to raise interest rates till 2024. And unfortunately, some of us believed them. I did. But fortunately, I also locked in on my interest rates early this year. So it's one of the few times I've actually got it right in locking in interest rates. But in general, the interest rates were so low, they were stimulatory. The Reserve Bank's got two jobs. Number one, to keep our inflation within a band of 2 to 3%. And the other is to keep employment stability in the Australian country. But it's only got one tool. it's actually got one big heavy lever of interest rates. Well, maybe it's got a different tool. It's also got the ability to talk and send messages out, and so convey a bit of fear or scare. But basically what they had to do during COVID, and no one knew what was going on, and so it's easy in hindsight to say they drop rates too low. They kept us out of the recession that other countries had. They stopped us getting the double-digit unemployment that other countries had and that we were scared of having, and they got us across the bridge through those difficult couple of years of the pandemic by stimulating the economy and lowering interest rates. This also was helped by the various state and federal government incentives. Now, moving forward, what's happening is that the Reserve Bank doesn't want to stimulate us anymore, so it's brought interest rates close to neutral. They're not exactly sure what neutral is, but it's in the range where it's not stimulatory anymore, but it's really not slowing us down enough yet. And with the issues happening overseas and the interest rates going up overseas and how that may affect our Australian dollar, the concern is that if they don't raise interest rates anymore, inflation is still going to be too high, too strong. And so I see probably another 0.25% interest rate rises. I'm not an economist. I've been a student of economy for over 5 decades, and the economists are arguing about where the interest rates should end. Even within the Reserve Bank, they're not sure what even neutral is. So they've got to wait and see what the effect is. They've given us a shock and awe package. They've gone way out, pushing up. But if they wanted to stop inflation, they had to. They had to do this hard. Now they've taken one foot off the brake. There's still one there at the moment. A few more interest rate rises. And then I think they're just going to wait and see how it goes, because if they push too hard down, what it's going to do is take us into a recession, and that's not what anyone wants.
And I think it'll be interesting to see how that plays out. We've seen some of the big banks predicting that cash rate could actually start to come down at the end of 2023, start of 2024. You mentioned inflation being higher. So if we start to see rates come down, we see inflation come down, we see immigration come up. We saw Tim Lawless, CoreLogic head of research, say that we might see a V-shaped recovery. Do you think that's where we could start to see the traction, the rubber hit the road again with the property market?
Well, Tim Lawless came out last week from the time of recording this, saying that in the first quarter of 2023, he believes the property market is going to improve. Every week I have a YouTube chat with Dr. Andrew Wilson that we call Property Insiders, and we've suggested that at the end of this year, we're probably going to find a floor. We haven't found it yet, but the market's looking for a floor at a lower point, a stability, and we're basing that on what we're finding on the ground with our team at Metropole and on auction clearance rates, because a lot of the other information is about what happened a month or 2 or 3 ago with regard to prices. But at the moment, auction clearance rates are rising slightly. Now, it's really Melbourne and Sydney, because the other auction markets, they're a little bit too small to be statistically significant. But auction clearance rates are in the mid-60s, not amongst around 40% like they were in 2018 when we were worried in early 2019 by the upcoming federal election. Sentiment inquiries in our business, and I know we spoke a moment ago in your business, people are looking at getting ready to get going. They're getting their ducks in a row. I think people have said, okay, I'm sick of this media. I'm sick of all the negative messages. I've got to move on with my life. They're factoring in another couple of interest rate rises and just moving on with their lives. So I agree with Tim Lawless that I believe we're going to have a turning point, but I wouldn't call it a V-shaped recovery. To me, V-shape means it's gone down, it's going to go up straight away. I think it's more likely we're going to have a period of stability, of not rising values, but no more falling values. So Melbourne and Sydney have got a bit further to go. Brisbane has now started to catch up and drop in value a bit. Adelaide's remained reasonably strong, but we're not going to drop back to the levels of pre-pandemic, and then life will get on again, Nathan.
Now, Michael, I've heard you say there's a current window of opportunity for those that have a long-term focus. Why do you say that? Well,
just look at what happened in early 2020 when everyone was worried what COVID would do to our property markets. Those clients of ours and yours who actually got into the market, their properties have gone up an unprecedented amount. I've seen this around the time of the 2008 global financial crisis, of the tech wreck in the early 2000s. If people have a long-term view and they are comfortable that the fundamentals of our economy won't change, this is a good time to get your ducks in a row, to do your research, get a good team around you, recognise moving forward the markets will be fragmented, so you can't just buy any property, but look for areas where people have got higher wages, gentrifying areas, people where good neighbourhoods where people are prepared to pay a premium to live there. And accept that once that cloud disappears and the sun comes out, other people will see it as well, and you're going to get ahead of them. So you're not buying because properties are cheap, but it's a buyer's market. So you're going to have a good negotiating position. So I see it as that time when we can buy better than we did 6 months ago, a year ago, and probably in 12 months' time, we're not going to buy as well as we can today.
And what do you think makes a good investment over the next 5 years?
Well, everyone's at a different stage of their investment cycle. So I think we've got to work through what a normal investor cycle is. First of all, they've got to educate themselves. Then in general, people have to build an asset base first. And once they've got a substantial asset base, then they can start lowering their loan to value ratios and moving to the cash flow stage. So good investment for somebody at the later stage of their journey is very different to the investment at the beginning when they still need to build an asset base. So when we put a strategic property plan together for our clients, it takes into account where you are in your life. So if you want to get from here, I don't know, you're in Brisbane and I'm in Melbourne, and if I put in my Google Maps, I want to get to Brisbane, it's going to show me 3 or 4 of those little blue lines, different routes. I could go the fastest way right up the middle of Australia. I could go up the coastal road slowly and see the scenic points. I could go the toll roads, which are quicker but more expensive, or maybe safer. So where we suggest people get to their end goal with investments will really depend upon how safe they want to be, if they want to stop along the way and have babies, go overseas, have trips, whatever. So we make different plans. We strategically plan for clients, which means that there isn't the right investment for you at your stage is different for me when I've got a very substantial property portfolio. But we're looking for assets that are going to be secure and stable. In other words, not fluctuate in value a lot, and over the long term grow at what I call wealth producing rates of return, which is above average. And currently, most of the properties on the market are not investment grade. People are holding on to their good properties. They don't need to sell. So it's really important to understand that you've got to choose the best asset. I'd rather own a few good assets than lots of secondary assets, because the compounding effect of the increased capital growth and rental growth of a quality asset will outperform the $50,000 bonus I get for buying something cheaply today.
Definitely agreed with you. Quality over quantity. I guess wrapping up, Michael, did you have any other final thoughts, and also how people can find you?
Okay. Well, final thoughts are, don't listen to the media. It's hard not to. And it's very difficult in today's market to do what other people are telling you not to do. If people are saying at barbecues and your friends and your family, they're all well-meaning, don't buy property, it's going to go down in value. Everyone's got an opinion, but they're not necessarily got the right to give you advice. I also think that it's a period of time we're moving into where it's going to be harder to do well in property. So get a good team of people around you, including a property strategist, including a proficient mortgage broker who understands how to get finance, because property investment is a game of finance with some houses thrown in the middle. And take a long-term perspective, take a long-term view, understanding that in Australia, what's going to underpin our property values is the growth of our nation, family formation. We're going to have, well, we've got 25.5 million people, and the government's got a plan of having close to 40 million people by the middle of the century. So if there's more of us, and if you agree that we're going to remain a wealthy nation, that's going to underpin the property values. So be comfortable in that and take a long-term perspective. To answer your question how you get onto me, just search Michael Yardney on social media. But I've got a podcast, and wherever you listen to podcasts, and every day we have a newsletter, propertyupdate.com.au, Property Update, where a whole lot of experts leave their opinions on what's happening in the property markets, Nathan.
Michael, we thank you very much for your time today.
My pleasure. Well, I hope you got a little bit of insight from my chat with Nathan, and in a moment I'm going to share my mindset message with you, but I'd like to clarify a little bit more, because there's all this news about property and the economy, the 24/7 news cycle, and I guess in general we want to actually have action. We've got to do something. But I'd love to start with a comment made by Warren Buffett many years ago, where he said, somebody's sitting in the shade of a tree today because somebody planted a tree a long time ago. I guess I found the same. Good property investing should be boring. Sure, everyone loves to hear stories of that 25-year-old who created a tech startup and made millions, or the property hotspot that outperformed. But in reality, the vast majority of us are going to find, or should find, property investing boring. A solid investment strategy should be as interesting as watching grass grow, or in Buffett's analogy, watching a tree grow. Planting a tree is a long-term bet. You don't plant a tree today and expect to have shade tomorrow. But if you plant the right seeds in the right conditions, sooner or later, time will work its magic and you'll have a tree. And it really is the same with property investing. There's no quick fix to all the problems in the world at the moment, and there's no quick fix to building and growing your wealth over time. It's about planning first and then doing. I think now is the right time to plan for the future seasons of your financial life. And I'm going to suggest that you should use the same team as me to plan for your financial future, and let my team at Metropole help you put together a strategic property plan. It's just as relevant for beginners looking for a time-tested property investment strategy in these challenging times as it is for established investors who are stuck, or maybe you're just wanting a second opinion on your own situation. So what is a strategic plan? Well, we create a plan to bring your future into the present so you can do something about it now. And it's not just about property, but a property plan's got multiple parts to it, including an asset protection plan and a tax plan and a rental growth plan and eventually a retirement and a living off equity plan. There's multiple bits to the plan. And the property you're eventually going to buy should be the physical manifestation of a whole lot of decisions you make in the right order. And that's why I recommend you have a complimentary clarity consultation with my team at Metropole so we can find out a bit more about you, your goals and your aspirations, and you can find out a bit about us and allow us to help you build, or allow us to build for you, a strategic property plan. Now, won't shoot everybody, and if it doesn't work, we'll tell you. Sometimes we just give people a $29 book, or we tell them to buy a book. No, we give them to them, don't we? Others may be just ready to use their buyer's agent or home buyer's agent services, and yet others need a strategic property plan. So it helps you safely create intergenerational wealth through property. Go to metropole.com.au, find out about our range of services, leave us your details, and I'd love to be part of your wealth creation strategy plans in the future. Oh, can I boast? We've recently won 3 awards from multiple international finance and money organisations. We've been voted most trusted investment consultancy company in Australia in 2022 and the best property investment consultants in Australia. I'm really proud of my team, and I hope you'd like to have them on your side to, well, I was going to say level the playing field, but it's wrong. We don't just even the odds, we stack the odds in your favour. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's Mindset Moment, I'd like to read to you an article written many, many decades ago by Jim Rohn. But some things just don't change. And his discussion was about facing the enemies within us. He was really talking about facing our fears. And today the world seems to be bringing on challenges, worries, fears from all directions, doesn't it? But Jim Rohn has got a great lesson for us, because he tells us we're not born with courage, but neither are we born with fear. He says maybe some of our fears are brought on by our experiences, by what somebody's told us about what we've read or heard. Some of our fears are valid, like walking alone in a bad part of town at 2 a.m. But once you learn to avoid that situation, you don't need to live in fear, do you? Says Jim Rohn. Fear, even the most basic ones, can totally destroy your ambitions. Fear can destroy your fortunes. Fear can destroy your relationships. Fear, if unchecked, can destroy our lives, said Jim Rohn. Fear is one of the many enemies lurking inside us. Let me tell you about 5 of the other enemies we face from within, said Jim Rohn. The first enemy that you've got to destroy before it destroys you is indifference, taught Jim Rohn. What a tragic disease this is. Oh, harm, I'll let it slide, I'll just drift along. Here's one problem with drifting. You can't drift your way to the top of the mountain. Now, the second enemy we face within, according to Jim Rohn, is the enemy of indecision. Indecision is the thief of opportunity, of enterprise, said Jim Rohn. It'll steal your chances for a better future. Take a sword to this enemy, said Jim Rohn. The third enemy inside us is doubt. Sure, there's room for healthy skepticism. You can't believe everything nowadays, can you? But also, you can't let doubt take over. Many people doubt the past, they doubt the future, they doubt each other, they doubt the government, they doubt the possibilities, they doubt the opportunities. Worst of all, they doubt themselves. Jim Rohn said, doubt will destroy your life and your chance to success. It'll empty both your bank account and your heart. He said, doubt's an enemy, go after it, get rid of it. The fourth enemy Jim Rohn warns us about is the enemy of worry. We've all got to worry sometimes. Just don't let it conquer you. Instead, just let it alarm you, said Jim Rohn. Worry can be useful. If you step off the curb in New York City and the taxi's coming, you've got something to worry about, said Jim Rohn. But you can't let worry loose like a mad dog that drives you into a small corner. Here's what you've got to do with your worries. You drive them into a small corner, said Jim Rohn. Whatever's out there to get you, you've got to get it. Whatever's pushing on you, you've got to push back. And the fifth enemy Jim Rohn wanted to warn us about is the enemy of over-caution. It's the timid approach to life, because timidity is not a virtue, it's an illness. If you let it go, it'll conquer you, according to Jim Rohn. Timid people don't get promoted, they don't advance and grow, they don't become powerful. You've got to avoid overcaution. Do battle with the enemy, do battle with your fears. So Jim Rohn teaches us to build your courage, to fight what's holding you back, what's keeping you from your goals and your dreams. He says be courageous in your life and in your pursuits of things, in pursuit of the things you want and becoming the person you want to become. Some great words of wisdom from one of my mentors, Jim Rohn. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?